Now, Jeff Chowdhry of Concept Ventures is joining us right now, the biggest pre-seed venture fund in the UK. Jeff, great to have you with us here. Thank you very much for your time. You know, I just want to outline some recent events with regards to what's happening in the UK quickly, and then I'll come to you for a quick reaction, right? Because it's been absolutely, I don't know if you've been tracking what's happening, but it's been crazy. So the story is this, that the Bank of England on Monday, which is this Monday, said that their bond buying program, basically intervention in bond markets, will end this Friday. Yesterday, in a public speech, the Bank of England governor reiterated that is the case. The intervention will end this Friday. This morning, the Financial Times put out a story citing sources that the Bank of England governor, had told bankers privately that, you know, if the conditions so warrant, they could extend the bond buying program beyond Friday. 2 hours later, the Financial Times puts out a story that an updated story saying that, you know, the governor told this to bankers before his Tuesday speech, in which he said that the program will end on Friday. And then we have a spokesperson of the Bank of England, Bloomberg, saying that the program will indeed end this Friday. Why is this so important? It's important simply because bond markets in the UK are having a domino effect around the world. You know, we've seen treasuries move, we've seen money going into the dollar, and we've seen equities reacting to what's happening there. Jeff, how do you read this, and what is your interpretation? How important is this for global markets? Global risk on, risk off. Go on.
Right. So thanks very much for having me on the show. I appreciate you being here. Let me give you 10 seconds of background. I'll give you some context. The sort of the core issue is something called, which is a sort of a corner of the UK pensions market, called liability-driven investment. I won't bore your viewers with the technicalities of it, but essentially what it means is that the pension funds in the UK essentially have to use derivatives in order to basically match the liabilities of the pension funds. The problem is because interest rates have gone up very quickly, they have had to sell these derivatives in order to maintain the exposure to this liability-driven investments. The result of which is the Bank of England stepped in last week and essentially bought the bonds of the pension funds in order to stop the bond market essentially from collapsing, and ultimately for the pension funds to stop collapsing. Now, you mentioned at your opening about will they continue with the bond buying, will they not continue with the bond buying? The role of a central bank, whether it's the Reserve Bank of India, the Bank of England, or the Federal Reserve, is ultimately financial security and, importantly, for the system as a whole. So if the Bank of England feels that this is a systematic risk to the banking system, then I'm sure they will continue with their bond purchases. Whatever statements you've seen in the press or whatever, they will continue with that process. Now, why is this important on a global basis? Well, on a global basis, if the Bank of England continues to buy gilts, that clearly pushes up yields, and that clearly has an effect on other bond markets around the world. So that, in a nutshell, is what the issue is, and I suspect volatility will definitely continue over the next few weeks.
Okay, so Bank of England being pulled in opposite directions, one by the requirements of the market, the pension fund, and the other by the economic data. But Jeff, just to get your views in on the global markets, you know, investors are just wary. They're tired of guessing which way, what's going to happen with respect to inflation, how many more rate hikes. And we've seen this very scary sell-off take place in the global market. You know, the debate keeps coming up, right? Is the Fed going to pivot, or is it time to stop guessing about when the Fed is going to pivot? Your take on what's happening and what are the implications for an investor out here in India?
I think there's a couple of implications. I think, you know, people talk obviously very, very short term about, you know, interest rates going up this year and the market being weak. This whole started in 2008. I know it's a long, long time ago. 14 years is a very, very long time. But the situation that we find ourselves in today is a result of the very aggressive quantitative easing which took place after the financial crisis. So we basically had 15 years of very, very easy money, low interest rates, consumers and institutions to some extent are in high levels of debt. And with interest rates going up, that's going to cause financial pain. So I'm not going to predict when the Fed is going to stop increasing interest rates, but it ain't going to be soon. I think the reality is inflation is going up, and the economies are in such a position that that rates have to go up across the world. And on top of that, you've got things like the Bank of England issue with the pension funds in the UK.
Okay, well, for now at least, despite there being an overarching cautionary situation, our own markets have been very resilient. Jeff, good afternoon. Is there a case now for a bigger bear market in the US, the ferocity of which could be perhaps more severe than what we've seen in the recent past?
Well, the S&P 500 has corrected by about 25% so far this year, which is a fairly significant correction. I think at this point in time, I think the market will continue to remain under pressure. I don't like forecasting levels for the market, etc., but I think it will continue to be under pressure, and although we have seen quite a lot of pressure so far. But remember, and again, this is what I like to say to sort of my mentors and my students that I teach in this area, the ultimate barometer of investment is the US 10-year Treasury. That is a thing that everything comes from. And with interest rates going up and the 10-year yield going up, that's a very, very difficult environment, particularly for equities and also for bonds.
Okay, and no peak anywhere in sight there, right?
I don't think so. I don't think so. I think at the moment the Fed is sort of trying to catch up with expectations as far as inflation is concerned. Obviously, you've got some inflation numbers coming out later on today. I think when the market realizes the Fed is ahead of the curve, that's probably the time to be dipping your toe in the water, both in terms of the bond and the equity markets. And as I say, the UK has its own problems.
Okay. Fair enough. Jeff, any thoughts on what's happening with China? We have later this week, that is on Sunday, the 20th Party Conference in China, and the big issue which for markets which is relevant immediately is the zero COVID policy, right? Which doesn't look like it's going to go anytime soon, at least not this year, maybe next year, is what the general expectation is. How important is that?
It's very important. I mean, by any measure, as everyone knows, COVID started in China, and so they are now neurotic about it more than perhaps any other country in the world. The zero COVID policy is a policy which obviously they're enacting because they're worried about what's happened, but more importantly, has a very, very severe impact on economic growth, both in China and the rest of the world. So this is not good news either for China or indeed for economic growth more globally in terms of the zero COVID policy.
Jeff, thank you very much for joining in today. Pleasure speaking with you. It's time to slip into a very short break. We'll come back and discuss more on the market. 10 minutes to go.